This is Capital Ideas TV. Coming up, the CEO of Canada Jetlines, starting a price rebellion in the airline sector, an analyst on Neo Lithium's whale of a mine, and small cap specialist Roger Dent with 3 investment ideas. The CEO of Canada Jetlines can't believe how complacent Canadians are in the prices they pay for air travel. Well, Stan Gadek wants to start a price rebellion in this country with an ultra-low-cost carrier. He says that when Canada Jetlines launches next year, it will have the lowest costs of any airline in North America. To find out how he's going to do that, here's our chat with Stan Gadek. So tell us exactly what you're starting here.
Well, Canada Jetlines is going to be Canada's first ultra-low-cost airline, a true ultra-low-cost airline. And by that I mean we're going to be able to offer ultra-low fares and then fees for additional services. So what does that mean? What are our fares going to be? They're going to be fares that are so low that they'll be basically the same price as a pair of jeans, literally. And that's how ultra-low-cost carriers can attract customers to their website and to their ticketing distribution channels, is by offering the lowest fare possible. Now, the way to be able to do that and make money is you have to have ultra-low costs. And so the focus of the airline is always on costs and efficiency. Because once you violate that offering to the customer and you're not offering them the lowest price in the market, you've lost the customer forever.
I heard you say today that you want to start a rebellion here in terms of cost for airline tickets. Yeah. So what's that going to look like?
Well, I'll tell you, the rebellion is against the high fares in Canada. And as I said in my earlier press conference today, I do not understand why Canadians are willing to put up with the high fare structure in Canada. I just don't understand it. It isn't necessary, it's not required, unless you have a high cost structure that you have to cover, which perhaps in the case of the incumbent airlines they do. But with the advances in technology and the way tickets are distributed and you can transact now over your smartphones, there's so many ways for airlines to build in efficiencies and cost savings and pass those on to the customers. So it's an anomaly here in Canada that I just don't understand. And so we're going to start a rebellion against that, high fares. We're going to rebel about it, and we're asking everyone to join us in that rebellion to bring airfares down here in Canada.
From what you hear anecdotally, are Canadians clamoring for that?
Well, I'll tell you, I cross the border frequently in Vancouver into Bellingham, Washington. I have 2 daughters in Seattle. It's anecdotal, but every time I come across the border into Canada and they look at my work permit and they say, "What do you do?" And I say, "Well, I'm starting a discount airline." "Really? Tell me about it." And the questions are always, well, when are you going to get started? Where are you going to fly from? What are your fares going to be? So that's just an anecdotal sample, but if the Customs Border officials are interested in a discount airline, that and all the other feedback that we're getting from people convinces us that we've got the right product here.
Now, you say you're going to have the lowest cost of any airline in North America, and when you
Absolutely.
say a pair of jeans, you're talking about a flight under $100?
Yes, for the base fare, absolutely. And I'm talking about a pair of affordable jeans, too. And I can make the statement that we're going to have the lowest costs because we've done a very comprehensive job in terms of modeling our financial projections over the next 5 years. So I know what our fleet plan is, I know what our level of operations are, I know our revenues and our expenses. And our costs are going to be about 9.5 cents per available seat mile. When we look at the other carriers, WestJet's costs, based on their 2016 numbers, are 12.5 cents. Spirit in the United States, when we adjust theirs on a Canadian currency basis, their costs are 9.9, Frontier's 10.2, Allegiant 10.8 cents. So right out of the box we're going to have much lower fares than the other guys. Air Canada, I didn't even model, their costs are off the charts, but they're a much more complex airline than we are.
Right. Now, you mentioned a bunch of low-cost airlines there. Do you look at them to see what they're doing right and wrong? Do you look at the Ryanairs and EasyJets of the world in Europe to come up with your model?
Absolutely we do. And in fact, I want to mention that on our board, we have 2 former executives of EasyJet, Flybe, and Wizz, which are 3 ultra-low-cost carriers in Europe. Saad Hamad was Chief Commercial Officer at EasyJet. John Stevenson was Chief Commercial Officer at Wizz, which is the Hungarian Eastern European ultra-low-cost carrier. And then Saad went on as CEO of Flybe. So we have excellent expertise on the board, and this is a working board. Our board members put a lot of input into the development of this business plan, as well as reviewing the financial projections that we have put together. And so the answer to your question is absolutely. We have to study and identify best practices among the ultra-low-cost carriers of the world. Why? Because it's a very demanding niche in terms of a business model. You have to have absolute discipline to adhere to the lowest possible costs. It's hard to get low costs. It's hard to maintain high productivity. It's not something that you can just achieve and then you're done. It has to be worked at every single day. And so that mindset has to be pervasive throughout the company. And it's got to emanate from the top and through every employee of that organization.
And Stan, tell us about the rollout. You're going to start with 2 planes next year, and then you're projecting 5 years down the road you'll have maybe as many 24 planes.
That's correct.
Yeah.
So we'll start operations June 1st, and we'll do what I call a soft start with 2 aircraft. And the reason for that is we have to go through a demonstration period with the government to show them that we're following our procedures and that we're safe to operate. 2 months after the soft start, we add airplane number 3 and 4. And then 2 months after that, we add airplane 5 and 6. So by the end of November, we will have 6 aircraft operating, serving 23 unique city pair markets, mostly out of Hamilton and Waterloo, but we'll also have service out of Halifax and St. John's going down to Florida at that time frame as well. So over 24 months, 12 airplanes, and our 5-year plan will get us to actually in excess of 24 aircraft.
Now, in terms of your experience, you're essentially a lifer in the airline sector. So it's interesting that you were chosen for this job. What do you think you bring to the table, and do you think that, and this is kind of a secondary question, but as an American, do you think America's a little more hard-charging, a little more aggressive than Canadians in terms of leading?
Well, no, I think the countries pretty much have the same business attitudes towards business. We want businesses to be successful and be profitable, and above all, we want to create jobs. So I think the 2 perspectives are equal there. But I will tell you that, again, it gets back to what I said earlier. I don't understand the complacency of Canadians to pay exorbitant airfares. I just don't get that. In terms of my coming on board, certainly I have the experience of having worked at many airlines. I have a keen focus on cost, having worked for a number of low-cost airlines. But I think also importantly, I know what not to do. And oftentimes, the difference between success and failure in this business are those little missteps in terms of doing something that you probably shouldn't have done as a strategic initiative. And so, with my experience as well as that of our board members that we have who have been in this space, I think we've got a pretty good bench in terms of guiding this company forward and making it successful. I know that there's been other attempts in Canada to start ultra-low-cost carriers and low-cost carriers. They've failed, and they failed for a variety of reasons. But we think that we've got, again, the knowledge and the experience to know how to avoid those pitfalls and to manage the business going forward, as well as competing with the competition which we're going to face.
And lastly, Stan, for investors, potential investors, what do you say to them in a couple of sentences to convince them that Canada Jetlines is a good investment? Sure.
I'll tell you, we're going to be embarking on a capital raise here in the very near future, and it's going to result in a structured financial deal, mostly debt. We have a fair amount of equity outstanding right now, and so we're going to be looking for a significant debt component to the capital structure in order to mitigate or avoid some of the dilution that would normally occur. We're going to be focusing initially on the foreign ownership component of capital. We have an exemption, as you know, from the Ministry of Transportation. We can go up to 49% foreign ownership. That's a very valuable exemption. And so we're going to focus on that sector of investment first, get that nailed down, and then we'll turn our attention to domestic investors.
We've had a cover story on Neo Lithium in our Capital Ideas Digest, and we interviewed the CEO, Dr. Waldo Perez, here in studio. Today, we have an analyst who's actually been to Neo Lithium's huge mine in Argentina. He's going to update the story for us. Here's our conversation with MacMurray Whale. MacMurray, you've been to Neo Lithium's mine in Argentina. So what was that experience like? What are they sitting on, and what makes this mine so unique?
The mine is located pretty high up in the Andes in Argentina. What makes it unique is they own the entire Solaris surface, so they don't have any other competitors in the region. But it's the highest grade mine, the highest grade and the lowest impurities of really any of the salars in Argentina. So it makes it a very special property.
The company came out with an update recently. What stood out for you? What are one of the 2 or 3 main things that stood out?
Well, the key thing is at this stage is to nail down some economics. So the PEA is coming out in October, and that will form a sort of a framework for what we would expect to see over the next few years. The key thing then for me that I'm watching is what the OPEX will be and what the CAPEX will be. And there was some indication the evaporation rate is on par with the rest of the rest of the region, and being a higher elevation, we'd like to see that you can actually evaporate this brine to concentrate it. So
okay, that's important to explain, because I saw that in your report. So,
right.
So that's important, the evaporation rate.
Right. So you want to have a high grade, you want to have low impurities, but beyond that, you want to be able to concentrate the brine before you process it in a plant. So the higher your evaporation rate, the smaller your ponds, the lower your CAPEX. The other issue is being able to get the brine out of the salar. You might have lots of lithium, but you need to be able to pump it, and that project has so far really good indications of the ability to get the brine out. So that'll be the next sort of layer of information we'll want to see over the next few years.
So when we see the preliminary economic assessment in October, will that move the stock, do you think?
I think it will. If the capital intensity of the project is on par with some of the other projects, and I would expect it would be given how high the grade is and the fact that the evaporation rate looks like it's in line, those 2 things suggest that PEA will bring in a CAPEX that's on par with some of the other projects. If it is, then it should be a positive development.
And we're looking at roughly a capital expenditure of something like $475 million. Is that about right? And as you say, that's in line with the other big projects?
What you're concerned with is how big the project is, how many tons per year you can produce, and for how long. So, you produce more per year, then your mine life might be shorter. In this case, what we'll be looking at is sort of the intensity of the CAPEX. How much does 500 million or 475 get you in terms of annual production?
And give us a timeline as far as Neo Lithium's construction of the mine and then production by 2022, correct?
Yeah. What's interesting is when this new management team took over the project, decided they were going to develop it, they've moved very rapidly. I'm a little surprised we're talking about a PEA, considering what I saw at site last December. They've come a long way, and they're moving very rapidly. So, the timeline to 2022 is completely reasonable. I think, if you went back 2 years, you'd think that's probably not possible. But the pace at which they've been putting together, doing the drilling and doing the evaporation tests has been quite remarkable.
And just back to the costs, so they're going to have to raise some money eventually. So through equity, debt, debt and equity, how do they do it?
When you look at the projects, most of them, when they're fully developed in terms of a feasibility study, you can get a fair amount of the project financing from debt. I would expect they'd be able to do the same thing. So perhaps half of the cost can be covered in debt and the other half in equity. I believe most analysts, if you look at what their expectations are, they've already baked in raises of issues of equity at reasonable prices to put in a dilution. So it's not a surprise that they would have to raise equity to fund the project.
Right. Let's pull back here at MacMurray and look at the lithium sector. What's supply like? What's demand like? We see all these projections for electric vehicle demand rising 7-fold by 2024. What's your impression?
If you look at the major producers of lithium, they have estimates of lithium demand at the low end around 500,000 tons per year. Markets around 200,000 tons this year, and that would be 500,000 by 2025. They're actually probably on the conservative end of the estimates. If you look at some of the battery makers and you estimate what each of them individually would need and you add them all up, there are some estimates as high as 700,000 tons. When you look at that, the industry today is very tight. The pricing we've seen, contract prices $13,000, $14,000 a ton. Spot prices $22,000 a ton. The expectations are we're in a window of 2 or 3 years where that tight supply-demand market persists. It keeps the price high so that the juniors can actually get projects off and running. And really, there's no expectations that I've seen of a price dropping off those sort of low teens for contract prices. So there is probably a 5-year window here at least, and anything beyond that is just hard to project what the majors will end up doing. Because capital will be deployed, it will go into the space, and we already see it happening. So there's a pent-up demand, there's a tight supply market, and that's why the pricing is high.
And lastly, when you look at Neo Lithium, give us the investment case in a nutshell for people who may want to tuck this away and just wait for the story to develop.
Yeah. At this stage, when you're pre-feasibility, you're really trying to understand what the resource looks like, and then you're trying to establish what the cost will be. In order to do that, you need to have a really credible team, and you're basically betting on that management team. And in Neo Lithium, you have a great resource, you have a rapid level of activities on site, and that's being managed by a very experienced management team. The CEO comes from Lithium Americas, where their feasibility study was probably the best I've seen in the industry, in the brine industry, and he's now running this project.
Right, and not to interrupt you, but we've had him in here, Dr. Waldo Perez, very passionate guy, engaging, smart, quite a charming guy, and you get the sense that he knows what he's doing.
Yeah. I think when you look at the basin where LAC and Orocobre have their assets, Orocobre had a much less well-developed feasibility study, but got their asset actually financed and up and running. LAC didn't. Part of that might have come down because Dr. Perez didn't move as quickly. I think what we've seen, what I said at the beginning, was that he's moving actually really quickly now. So, he showed that he can actually achieve great results. Now I think he's actually showing he can do that in a timeline that makes sense given the situation in the market.
Roger Dent has been a successful small cap analyst and investor for a couple of decades. He's the head of Quinn Capital, which has recently changed its investment strategy. Today he's going to bring you 3 ideas. Here's our conversation with Roger Dent. You're with Quinn Capital, and you have a very definite strategy. Tell us about that.
Well, we've, for a number of years, been focused on the Canadian micro-cap and small-cap sectors. More recently, in the spring, we decided to focus primarily on the cannabis space. So for the last 4 or 5 months, our new investments have basically all been in the cannabis space in Canada and also in the United States. That being said, we still have some other legacy investments in other sectors.
Now, to that end, one of the ideas you're bringing us today is Canada House Wellness. Now, this is essentially 3 entities brought into one. So explain what they do, because it seems as if everybody and his brother and sister is in the marijuana space, but how are they different?
Well, the one thing they've got that's very similar to others is a nearly complete facility for growing cannabis plants. The thing that they've got that is a very interesting extra, they have a business that basically acquires patients with a major focus on the military. The military has many members and former members that require medical marijuana for PTSD and other reasons, and they're very attractive patients. So we really like the combination of the growing operation plus the patient acquisition business, and of course what we also liked was the valuation at which we were able to enter Canada House. So we think it's at a very interesting point of inflection. It's got its cultivation license, so it's progressing toward full licensing. We expect that the full license should follow somewhere around the end of the year or early in the new year.
Now, what stands out in their investor presentation are some very ambitious growth plans. They're looking at revenue and earnings leaping the next several quarters and years. So can you give us some of the projections there and where you may see the stock in a year or two?
Well, as far as revenue projections, obviously one of the major factors will be next year with the legalization of recreational cannabis. It's still, I think, difficult to have precise revenue expectations. It's a market that is obviously going to have a huge amount of growth. One of the beauties of the cannabis business is that it has very attractive margins. So one doesn't need a very large share of this new market to generate some very strong earnings. So we are expecting very strong revenue growth starting once they've received the marketing license, but particularly heading into next year with recreational cannabis use. As far as stock price projection goes, we think at current levels, 20 cents, it's undervalued based on the current situation, but we think with the completion of their facility and the award of the license, it should move back to historic highs north of 30 cents.
Let's move on, Roger, to another one of your ideas. You sit on the board of Deveron UAS. We've had the CEO in here a couple of times, David McMillan, an impressive young guy. So drone data for agriculture, refresh our memories as to the model.
Agriculture is becoming a very technologically sophisticated business, a very large corporate business. And they're interested as an industry in technological solutions that will lead to better performance. So what Deveron is focused on is using drones to collect information from the field on a very low cost and a very rapid basis. So farmers can understand which areas may require additional fertilizing, may require additional water. It allows them to basically increase their yields and improve the efficiency of the farming operation.
And would you say that Deveron UAS is gaining more and more acceptance and that they're in the midst of a pretty good growth story here?
I certainly think so. This is a very new industry. We're selling drone data collection to farmers for the very first time. We've had some good success and good growth so far. We've got some excellent partnerships with very influential companies that are marketing other products to farmers, and we think that going in partnership with, for instance, fertilizer companies or seed companies is a very good way to approach farmers and distribute the product and build the case for using drones.
So we'll keep watching Deveron. Now the other one that you've brought to us today is Posera, Payment Solutions. And just anecdotally, I was at a cake shop the other day. They were using an iPad for point of sale solution with some sort of program. I heard an ad from Moneris on the radio today. They're in it as well. So again, how does this company differentiate in a sector that seems kind of crowded?
Well, there are many things going on in the payment space. Posera actually has 3 separate businesses in restaurant payments. 2 legacy businesses. One, they provide the point-of-sale terminals to a very large proportion of the Tim Hortons restaurants in Canada. They also have a solution for conventional table service restaurants. But the thing that has us most excited about Posera is their initiative in what's called table pay in the United States. Here in Canada, most restaurants, when you go to pay, they bring the machine to the table and you enter your credit card information. You keep the credit card in your own personal possession. You don't have to worry about what's happening to your credit card in the back when they go to process the payment. In the United States, table pay has a very low penetration. It's virtually an unused technology. Mm-hmm. And what Posera has done is partnered with several of the major companies that are in the payment solution business in the United States. They've got a model which we find very attractive, that basically they will get licensing fees with very high margins sold by these various partners into this space. We are highly confident that table pay will become the standard in the United States. Consumers like it. It reduces credit card fraud. It's a very attractive technology. We've seen how successful it is in Canada. So we think Posera can see extremely strong growth as a result of table pay being rolled out into the United States. And this is starting literally in the current quarter.
And lastly, Roger, with Posera, last quarter they had revenue of more than $4 million, but they're not profitable yet. So again, give us some projections a year or two out and where you may see the stock.
Well, the table pay opportunity in the United States is extremely large. It's 10 times the size of the Canadian marketplace. Given the business model that Posera's got, where they're only collecting licensing fees without really having to take on any particular costs of going into the United States market. We would hope to see Pacera turn to profitability in the new year, given the modest market cap at which the stock is now trading, we think that this stock can double or more in the upcoming year.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.